Hi and welcome to the fourth of our Canadian Focus breakout sessions. My name is Becky Oakes and I am the AVP of Advanced Analytics here at Equifax Canada. For this session, I wanted to focus on one of the hot topics currently in the credit industry. How can we better predict what impact COVID is going to have on the consumer credit industry over the coming months? And how can we leverage data and analytics going forward to improve our ability to proactively adapt to changing environments in the future? Let's start our journey taking a step back to the Canadian market before the pandemic. Now, for the most part, 2018-2019 were relatively stable periods in the consumer credit industry, with average non-mortgage debt only showing a gradual change during 2019. However, there were a few subsegments that were starting to cause us some concern. So the interest rate increases towards the end of 2018 and into the start of 2019 were starting to place some stress on consumers with large variable rate products such as HELOCs, and in turn that led to a fairly unusual spike in insolvencies among some of the traditionally more lower risk consumers. Now, movement in oil prices and other provincial economic changes meant that delinquencies were increasing at rates above the national average in certain areas, such as Alberta and BC. And on the consumer behaviour front, we saw increases in revolving credit usage, such as on credit cards, combined with drops in the pay rate, which is the amount of the balance paid each month. So the market was in a good position, but there were definitely pockets of stress starting to form. Then COVID happened. Now, as we all know, March to May was a really difficult period for our economy. Employment rate fell to the lowest for more than 25 years, and a significant number of consumers and businesses were impacted as a result of the lockdowns. But there was some good news that came in the form of the government and lender support mechanisms. These have been really pivotal in helping consumers significantly impacted by the pandemic and lockdowns to manage their finances throughout this period. So this help has been widespread. Almost 1 in 9 of consumers have utilised some form of payment deferral, and this usage wasn't limited to those who were traditionally always seen as high risk. Now, payment deferral rates were typically higher for those consumers with slightly lower credit risk scores, but there still was a very large number of consumers impacted who previously had excellent credit behaviours. June and July brought some positive news to the economy. So as the lockdowns started to relax, employment levels increased to almost 96% of what they were pre-COVID, and retail sales recovered to levels earlier in the year. The same improvement was also seen in the credit industry, so we saw a resurgence in terms of consumers actively looking for new credit. This was mainly driven by two things. So firstly, we saw large increases in the housing market, and along with that we saw auto loan sales start to rise also. But unfortunately, the picture isn't entirely a rosy one. Despite these support mechanisms, during Q2 we did see a slight increase in overall balance delinquency, but it's really a tale that has two sides to it. If we take HELOCs, for example, the second quarter saw some really positive movements in terms of segments of consumers paying down their lines at a much higher rate than prior to COVID. But at the same time, the total balance and percentage balance of these lines which were delinquent jumped significantly. So already we're starting to see that this recovery is not even across all consumer groups. We have uneven recovery, but we also have a lot of unknowns that can dramatically impact our models when trying to predict what may or may not happen over the coming months. There are certain industries which employ a large number of consumers, like the hospitality and restaurant sectors, where potentially the impact of COVID is still yet to hit. As we move into the fall and into winter, this could have a dramatic impact on the ability for individuals to maintain their debt payments. There are some provinces which are starting to see infection volumes creep back up. This creates that risk of potential localised lockdowns being reinstated, along with the increased concern that things like children returning to school could speed up some of the deterioration we're seeing in numbers. There's also a lot of concern around how the consumers will manage once some of the government support is reduced. So as CERB is pulled back and replaced with alternative mechanisms, will this lead to an increase in insolvencies? There are many unknowns, and we have very few, if any, historic data points to help us predict analytically what will happen. So what do? Well, firstly, as I'm sure many of you already are, you should be thinking about different stress scenarios. What is most likely to happen and when, and varying degrees of impact. But the question we get asked a lot at the moment is, can we do more than just that? Well, the simple answer is yes, you can. But unlike most analytical profiling and segmentation we do here at Equifax, with limited historic data points, this is as much art as it is science right now. So firstly, with uneven recovery, you need to think about two aspects to your portfolio. How recovery may differ for certain individuals. So for example, were consumers already delinquent on trades before COVID started? Have they been making deferred payments? Were their credit scores maybe trending up or down before? And secondly, are there any stresses being seen in certain cities or provinces that may suggest slower recovery? If an individual lives in a region that is reliant on tourism, for example, could that recovery be much slower? Are there areas where overall deferral rates are much higher than the average? Were there existing stresses like we were seeing in Alberta with increasing delinquency prior to COVID due to falling oil prices? The easiest way to dig a bit deeper analytically is with clustering. This is something my team are currently developing for Canada right now. We are taking key attributes and in some cases developing new ones to more accurately reflect some of the COVID impacts like deferrals and grouping consumers together into clusters of similar behaviours, either individually or geographically. What this enables us to do is to profile what these varying groups of consumers look like and in turn utilise these segments or clusters in our forecasting models or account management or adjudication strategies. Data-wise, we are leveraging trended attributes like change in score or delinquency, geographical aggregations, so what's happening at an FSA level, deferral rates, revolving credit usage, that sort of thing. If we look at a couple of examples, we could have a segment where a group of consumers had strong credit scores prior to COVID, low delinquency regionally, and low changes in unemployment during the pandemic. These would typically remain low risk and actually may be good opportunities for continued growth. On the other hand, we could have a group of consumers who were already overburdened with debt prior to COVID, who have had to defer payments during the pandemic, and who live in an area which has seen high business closure rates and overall high deferral levels. These could be deemed higher risk of delinquency or insolvency compared to the same individual prior to COVID. The key thing to remember here is that although this general approach is going to be helpful in understanding the risk associated in your portfolios during COVID, the same idea can be used effectively to identify and proactively manage future events. For example, if we talk about macroeconomic shifts like interest rate change, we could utilise segmentation and clustering to help find those groups of consumers with high variable rate products that could be more sensitive to that type of macro movement, enabling proactive treatments to be applied. On the micro side, traditional scores like credit scores may not identify fully regional stresses or maybe industry subgroups where there is something unusual occurring that could impact the underlying risk. Profiling, clustering, and developing shorter-term models to complement traditional scoring approaches can help develop a more holistic view of what is truly going on. Let me show you a quick example of how this can work. At the start, I mentioned that there were some areas of concern in the Canadian market during 2019, specifically around unexpected insolvency increases. Historically, insolvencies have always followed a similar pattern to delinquency. So delinquency goes up, insolvencies go up at a similar rate. But in 2019, this behaviour changed. We were seeing more and more consumers file for bankruptcy and consumer proposals with no signs of stress prior. Our traditional bankruptcy scores were still rank ordering well, but there was a pocket of consumers that had good bankruptcy scores 6 months prior to becoming insolvent, and in particular, a large chunk of these were what we called surprise insolvencies. There were no obvious warning signs that insolvency was imminent. As mentioned earlier, what we found was that interest rate rises during 2018 were putting stresses on consumers with high levels of variable rate debt. This was a subgroup of the Canadian population that was only really being stressed because of that macro change and only really impacted at a micro level those with things like large HELOC balances. Our traditional bankruptcy scores predict bankruptcies much further out, such as 24 months. They only really utilise individual attributes, and we tend to use a wide development period to build them. As a team, we decided to develop a much shorter-term model that predicted just 6 months out, that leveraged both individual and aggregated data, and that had a smaller development window so that relatively short-term shifts would be identified. In this second model, we found HELOC balances and utilisation were some of the higher predictors of insolvency versus our traditional models that utilise things like over-limit behaviour or inquiries. It naturally picked up the effect of the interest rate on the underlying risk. Now, the analysts among you may say, isn't this overfitting? And the simple answer is, to a degree, yes it is. But in the same way fraud modelling works, sometimes overfitting isn't a bad thing. As long as you know it's there, it's intentional, and you know what you can and can't use for that type of model. This idea of combining traditional scores with short-term modelling or profiling to detect key market shifts is definitely a step forward in how we as an industry can get better at identifying underlying risk movement. If we can identify them earlier, we can reduce losses overall. So there are 4 things I would love for you to take away from this breakout session today. Firstly, this is not going to be an even recovery for all consumers. It's really important that your adjudication and account management strategies are prepared for that. Secondly, there is no magical analytical algorithm that is going to have the answers, but there are certainly analytical techniques and segmentation that can really help in finding pockets of risk or indeed no risk in your portfolios. Thirdly, COVID is not going to be the last sudden change in the market we see, so we need to get much better at identifying those movements quicker. And finally, complementing traditional credit risk methods with alternative data and different types of models over different periods, it can really help close the gap on what you do and don't know about your customers. Thank you for listening today. I'm happy to take any questions.